I'm going to show you 3 price charts that Wall Street doesn't want you to connect. The first chart shows silver from 2000 to 2008, the second from 2009 to 2012, the third from 2018 to today. Each shows a massive silver rally that financial analysts explained away as inflation fears, industrial demand, or safe haven flows. Each of these silver rallies began within months of a major world leader attempting to sell oil in something other than US dollars. And each of those leaders is now dead. I'm your host. This is the Stack Guy. And today, I'm going to show you the correlation between petrodollar enforcement and silver prices that could explain the next major move in precious metals. Let me be very clear about what this video is and what it isn't. This is not a conspiracy theory. These are documented historical events with publicly available price data. What I'm going to show you is a pattern. In November 2000, Saddam Hussein made an announcement that barely made headlines in the Western press. Iraq would begin selling its oil in euros instead of US dollars. This was during the UN Oil for Food program. Iraq's oil production was limited. Most analysts dismissed it as a symbolic gesture from a dictator with limited options. It doesn't matter if Iraq's oil sales were small. What matters is the precedent. If Iraq successfully sold oil in euros, other countries might follow. OPEC countries, Russia, Venezuela, Iran. The entire petrodollar system rested on one principle. Oil is only sold in dollars. In January 2000, silver was trading at $5.20 per ounce. By November 2000, silver had actually dipped to around $4.60. Then something started to change. In March 2003, the United States invaded Iraq. The stated reason? Weapons of mass destruction. Saddam's links to terrorism, the threat to regional stability. Those weapons of mass destruction were never found. Within months of the U.S. occupation, Iraq's oil sales were switched back to U.S. dollars. Paul Bremer made it one of his first administrative decisions in June 2003. Iraq's brief experiment with euro-denominated oil sales was over. From the invasion in March 2003, silver began a rally that would last for 8 years. By December 2003, silver was at $6. By 2004, $7. By 2006, $13. By 2008, $20. And in April 2011, silver reached $49.80 per ounce. From the Iraq invasion in 2003 to the peak in 2011, silver rose from $4.60 to $49.80. That's a 982% gain. Why did silver start its historic bull run in 2003? The exact year the U.S. removed a leader who tried to sell oil outside the dollar system? Because markets are forward-looking. Markets price in structural changes before the mainstream realizes what's happening. The Iraq invasion of 2003 sent a message to every country on earth. Challenge the petrodollar and face regime change. The silver market heard that message. It rallied for 8 years. But the message didn't stick, because 8 years later another leader tried the exact same thing. Muammar Gaddafi ruled Libya for 42 years. He survived coup attempts, U.S. airstrikes in the 1980s, international sanctions, and isolation. But he didn't survive what he tried to do in 2009. In 2009, Gaddafi began proposing the gold dinar, a unified African currency backed by gold that would be used to sell African oil and resources. Libya had 144 tons of gold reserves. He gave speeches at the African Union. He put Libya's oil wealth and gold reserves behind the proposal. He called for Africa to adopt the gold dinar and reject the dollar and euro, which he called currencies of the colonizers. Saddam switched to an existing fiat currency, the euro. That's bad for the dollar. But Gaddafi was proposing a return to gold-backed money for oil sales. This wouldn't just challenge dollar dominance, it would challenge the entire post-1971 fiat currency system. And in February 2011, protests began in Libya. Within days, they escalated into armed rebellion. By March 2011, NATO intervened with airstrikes under the justification of protecting civilians. In October 2011, Gaddafi was captured and killed by rebel forces. Within months, the National Transitional Council announced the creation of a new central bank. One of their first moves was to establish a bank that would operate in dollars. Libya's gold reserves? They've been dispersed, sold off, or remain unaccounted for to this day. The gold dinar plan died with Gaddafi. In January 2009, when Gaddafi began seriously pushing the gold dinar plan, silver was at $11 per ounce. By January 2011, when the Libyan uprising began, silver had climbed to $20. March 2011, silver broke $36. April 2011, silver hit $49.80, the highest price since 1980. The peak of the silver rally happened in the exact same month as the peak of NATO intervention in Libya. Then, as Gaddafi's regime fell and the gold dinar plan died, silver crashed. By September 2011, silver was back to $30. By December 2011, $26. The entire parabolic move up and the crash back down happened during the Libya regime change operation. In the emails released from Hillary Clinton's private server, there's a memo from her advisor, Sidney Blumenthal, dated April 2nd, 2011. The memo discusses Gaddafi's gold and the threat it posed. Gaddafi has 143 tons of gold and a similar amount of silver, which he planned to use to establish an African currency as an alternative to the franc and dollar. This wasn't hidden. It was documented. The threat of Gaddafi's gold dinar was explicitly known to U.S. policymakers. And within months, Gaddafi was dead and the gold dinar plan was finished. The silver market rallied to an all-time high during this intervention, then crashed when the petrodollar threat was eliminated. But there's a third case, and this one is still ongoing. Hugo Chávez became president of Venezuela in 1999. Venezuela has the largest proven oil reserves in the world, larger than Saudi Arabia. In 2006, Chávez publicly threatened to switch Venezuela's oil sales from dollars to euros. He increased oil trade with China, settling some contracts in yuan. In 2007, Chávez began repatriating Venezuela's gold reserves from Western banks. By 2011, he had brought back 160 tons of gold from banks in the US and Europe, in his own words, to protect Venezuela's wealth from US seizure. Unlike Saddam and Gaddafi, Chávez died of cancer in 2013, but the economic warfare against Venezuela didn't end. It escalated. Under his successor, Nicolas Maduro, Venezuela continued dedollarization efforts. By 2017, Venezuela launched the Petrodollar, a cryptocurrency supposedly backed by oil reserves, to circumvent US sanctions. The US response? Sanctions, asset freezes, recognition of an alternative government, attempts to starve the Venezuelan economy. Venezuela has not been invaded, but it has been subjected to the most comprehensive economic warfare short of military intervention. Venezuela's oil, still being sold to China, to India, to Russia, in yuan, in rupees, in barter arrangements, not in dollars. In 2006, when Chávez first threatened to move oil sales to euros, silver was at $11. By 2011, when he was repatriating gold, silver hit $49. After Chávez's death in 2013, as U.S. sanctions increased, silver fell back to $15, $20 and remained suppressed for years. But here's what's happening now. In 2022, after the Russia sanctions demonstrated that alternative payment systems can work, Venezuela intensified oil sales in yuan. By 2023, the majority of Venezuela's oil exports were settled in non-dollar currencies. And silver? In 2022, silver was $21. Today, it's $75. Don't let me lay out the pattern clearly. 2000-2003. Saddam switches to euro oil sales. 2003, U.S. invasion. Oil switched back to dollars. Silver begins 8-year rally from $460 to $49. 2009-2011, Gaddafi proposes gold dinar. 2011, NATO intervention. Gaddafi killed, plan dies. Silver rallies to $49 during intervention, then crashes. 2006 and 2013, Chávez threatens de-dollarization. Sanctions, economic warfare, regime survival but isolation. Silver rallies from $11 to $49, then suppressed. 2022 present. Multiple countries move away from dollar. Sanctions on Russia fail. Alternative payment systems prove viable. Silver rallies from $21 to $75. Every single time a major oil producer has seriously challenged the petrodollar system, one of two things has happened. The leader has been removed, or the country has been subjected to extreme economic warfare. And every single time, silver has rallied. Why? Because the market understands something most people don't. Enforcing the petrodollar system requires demonstrating credible military and economic power. The demonstration reasserts dollar dominance in the short term, but it also reveals the system's fragility. It signals to other countries, you need insurance, you need gold, you need alternatives. This creates a paradox. Petrodollar enforcement rallies the dollar in the short term, but it rallies precious metals even more in the medium term, because markets are forward-looking. They see that a system that requires military enforcement to survive is not a system that will last forever. Every empire in history has faced this moment. Rome debased its currency and enforced it with legions. Spain debased its currency and enforced it with conquistadors. Britain debased its currency and enforced it with the Royal Navy. All of them eventually faced the same problem. Enforcement becomes too expensive. We are watching that fracture happen in real time. Right now, the gold to silver ratio sits at 63-1. During precious metals, bull markets driven by monetary system crises, that ratio compresses to 30-1 or lower. In 1980, during the Iranian Revolution and oil shocks, the ratio briefly touched 17-1. In 2011, during the Libya intervention and peak QE, it compressed to 31-1. If we return to 30-1, with gold at $4,145 where it is today, silver would be $158 per ounce. That's not speculation. That's historical pattern recognition. You don't need to time it perfectly. You don't need to know the exact date that Saudi Arabia announces when oil sales or Iran faces another escalation. You just need to understand the structural pattern. This challenge is bigger than anything we've seen in 50 years. You will never see this analysis on CNBC. You will never read this in the Wall Street Journal. You will never hear a Federal Reserve official connect these dots. Because to acknowledge this pattern is to acknowledge three uncomfortable truths. U.S. foreign policy driven by petrodollar protection. Dollar reserve status dependent on enforcement, that enforcement becoming impossible. But the silver market speaks the truth that institutions won't. $4.60 to $49 after Iraq, $11 to $49 during Libya, $21 to $75 as the broader system fractures. The pattern is undeniable. If you're stacking silver, you need to understand this pattern because it tells you three things. One, silver's current rally is not a short-term trade. It's a structural repricing based on a multi-decade shift in the global monetary system. Two, the volatility will continue. Every escalation in the Middle East, every new currency agreement, every sanctions package, these will move silver because they're all part of the same underlying story. Three, the end game is repricing. When the petrodollar system finally breaks, not if, but when, silver will reprice to reflect its role as real money in a post-dollar dominance world. Three leaders tried to sell oil outside the dollar system. Saddam Hussein, Muammar Gaddafi, Hugo Chávez, all three are dead. But the idea didn't die with them, because the idea isn't about any one leader. It's about the mathematics of the system. You cannot run trillion-dollar deficits forever. You cannot print unlimited currency forever. You cannot weaponize your currency forever, not without consequences. The consequences are playing out now, in yuan oil contracts, in central bank gold buying, in BRICS expansion, in $75 silver. The question is not whether the petrodollar system will end. The question is whether you'll be positioned correctly when it does. Tell me in the comments, do you think the petrodollar enforcement playbook still works in 2025? Or has the game changed? Drop your thoughts below. Stack smart, stack physical, stay informed.